This conference will now be recorded.
Okay, and we are getting ready to start. So, I want everybody, if you haven't typed in already, I want you to tell me who you won't fail. Who you won't fail. As I've told you, we will be doing some psychology. This is very, very important part of trading, part of life, and I'll explain further. But I want to know from every single one of you who you won't fail for. Derek, you went and got married and had children in a short amount of time that I've known you. Well done. Congratulations. Brilliant. Kevin, my wife and kids, love it. PJ, my mum, and myself. Priyesh, your newly born son. Absolutely. Community. Ah, love that. And my community. Sorry to hear that, Derek. I know the feeling. Both mine also passed not too long ago. Myself and family. Okay, brilliant. Well, first of all, welcome to our options class number 2. Hope you all enjoyed and got plenty of information yesterday. That's only the beginning. Today, we are now going to go into more of an example on prints and start the protocol or strategy that's used. But before we do that, I want to start off with a little bit of psychology. And here's the psychology of how we become the most important part of any success that we are going to achieve. At the end of the day, you are the vehicle that drives success, especially as we are relating everything back to trading, especially in trading. In trading, unlike other things in life, business, what have you, where success can be as contingent upon the teams that you build, upon the products and services, upon how well you execute in comparison to your competitors, the economical changes and so forth, and how the economy is. When it comes to trading, there are no excuses. There is no finger pointing. There is nobody that's going to carry your weight. There's nobody that's going to do the work for you. And there's nobody that's going to want it. Only you can want it. Only you have the ability and the opportunity to succeed, but that all requires how well are you prepared to find success. As I always say, trading or the stock market is a mirror into yourself. So every time that you come to your platform or screen, you know or you don't know how prepared you are. Whether you had the right habits in the morning, whether you were mentally preparing yourself by meditating, by going to the gym, and getting the dopamine and getting the endorphins going, getting your body awake and ready and focused, whether you're eating and hydrating correctly, whether you meditate to clear your mind, whether you're like me and have no social media. And I took social media off in 2020 for the purpose of not having a bunch of exposed, useless thoughts to everything that goes on social media. I wanted complete and clear clarity in my mind so that I can use all my bandwidth to focus on the things that are more important to me. And just like yourselves, my family is everything to me. I am everything to me. And so, knowing these things, I do not want to fail in life and fail as a trader. So, one of the best ways to do that is that you have to curate your life, curate your habits and your discipline, and be ready and prepared to meet opportunity when it comes your way. So we can expand upon that a little bit later on, but I did want to go into that just a little bit, just to get your minds going a bit. Now, I'm sure you guys, again, have read the confidentiality notice and a disclaimer. We just need to do this in the beginning, so please have that read. Hope you guys have your notes and so forth ready. Write down any questions. As you know, as we go through the sections, there will be Q&A at the end as well. So let's get started. So let's talk. What are options? Just a basic overview of how options work. One option contract is equivalent to 100 shares. So basically, when you buy a contract, one contract, Look at that as being the equivalent to 100 shares that you are controlling for a period of time. So if we take this example, and in this example, it's Dave and Doug, two people that you are quite aware of. Dave owns 100 shares of Apple at $10. Now, we're going to say right now that Apple, and I'm just seeing if I have it here, Apple is at trading currently at, well, hold on. Dave owns 100 shares of Apple at $10. Okay. So Dave is the owner of the shares. Doug wants to control Dave's 100 shares by purchasing it as one option contract. So basically what that means, me and Dave are sitting around, and clearly you understand this is not how options work, but this is just a analogy to make it easier for you to understand. So let's just say, for example, I go to Dave and I say, Dave, I know you own Apple. And Dave's like, yeah, I do. And I'm like, Dave, you got 100 shares of Apple, correct? And he goes, yes. And I say, would you be interested in allowing me to put a option contract on those 100 shares and controlling it for a certain amount of time? And let's say a period of 4 months. While I'm on this part, remember one thing, and we're going to get to what I would call the sweet spot of my strategy. But I do not purchase less than 4 months. Make a note. Very important. I do not purchase a contract less than 4 months out. I give myself ample time for my stock to meet its price target. Number two, as I explained yesterday, I noticed many times when the market volume got weaker and I had a minimum 3 month period at that moment, many times I was missing my mark by a week or two. Hence, I now have a minimum 4 month out period. So, going back to this. So I go to Dave and I say, Dave, I want to control your 100 shares. Let me place an option contract. And I'm going to hold it for 4 months. And he says, okay. And I say, how about we do it at a strike price of 15? Now, Dave has this at $10. And he says, 15, okay. Dave, in his mind, is thinking to himself, it's been stuck at $10 for 3-4 months. I don't know why this man thinks for any reason that in the next 4 months, this thing not only can go to a strike price of 15, but in order for this gentleman to make any form of profit, it needs to move past 15. Now, strike price. What is a strike price in options? The strike price, quite simply, is the number that up to which point all profits are Dave's. After 15, all profits are Doug's. So if we looked, as we can see, all profits up to 15 belong to Dave, and anything above belongs to Doug. So Dave agrees to this agreement for a fee of $2.50 a contract. So if you do $2.50 a contract, that what you have to do to get the absolute price or the cost to control a option contract, which costs $2.50, is quite simply times 250 by 100 shares. So for me to control 100 shares, or the equivalent now of one contract, we're not going to say shares no more. You guys understand that one contract is 100 shares. So for me to control that one contract, sorry, just had to cough a bit. So for me to control that one contract, I have to pay Dave $250. Now, if I have to pay him $250 and I am looking to make a profit, then we know already that everything up to 15 is Dave's. Then on top of the 15, I have a cost. And my cost is $250. So if we looked at that per share, $2.50, that technically means that I don't start making profit until what number? If everything up to 15 is Dave's, I have to pay $2.50. Where is the number of the complete total of where he makes money, add in my cost? At what number do I start making money? Absolutely correct. Thank you, Owen, Anthony, PJ, Ellie. 1750. So it's after 1750 that I technically start making a profit. Now, 2 months into the agreement, Apple beats earnings and moves to $20. So let's just say 60 days in, and this particular situation, earnings were within that climate, and earnings happen, and boom, great earnings goes to $20. At that particular moment, I have $2.50 in profit. Because if you take $20 and minus 17.50, which would be everything that Dave makes, including my cost of 250, I make $2.50. So as you can see, Doug sells a contract right here for $20. $15 is a strike price. So you got a $5 gross margin. Are we all aware? Do we know what gross margin means? Just give me a yes, please, or a no. Perfect. And don't be afraid if you don't know. More than happy to explain. So, okay, brilliant. Everybody knows what that means. So you got $5 gross margin minus $2.50 in cost. So it's a 250 net profit. Now, how much did I pay for this contract again? Could someone please tell me and put it in the chat? How much was my profit? So then how much was my return on investment in 60 days? Now, who over here likes 100% return on their money in 60 days? Does anybody have a clue what is the basic criteria that most people are happy to earn in percentage on if they had passive income on a yearly basis? Do you know what most people would be more than happy? Exactly. That's right. 7 to 10, 8 to 12. So, yeah, you're right. 8 to 12% is what you're hoping for. Most people are making about 3.2 to 4.2%, believe it or not, or a lot less if they'd leave it in their bank. So I'd assume these are great returns. Now, let me ask you a question. Let's say I have this contract for 4 months, correct? So we do the deal. I now am controlling Dave's 100 shares. A week into this agreement, some news comes out, let's just say. And the news comes out, and Apple's got a new product, and everybody's well excited, and it moves to 15 in a week. What happens to the value of my contract? Do you think it still remains at 250 a week later in the open market? The premium increases. Why does it increase? It increases because you're still got basically 4 months to get over 15. Because does anything change with the contract? It does not. Now, what's the beauty about options is there's two ways that you can profit. And those of you who have been in options and been doing it for years, you'll know that nearly all the time you're able to get your investment out before it even gets to strike. So this same option contract that I purchased from Dave, that I'm controlling for 4 months, can be signed over to anybody in the open market who wants to control my shares and take over that position. Have you guys ever heard when you buy real estate or you signed a real estate contract, at the end they put and or assigns? Have you ever heard of that term? If you haven't, not a problem. If you have, just type it in there. So when you're purchasing a house or you're purchasing a business, residential or commercial contract, a lot of times, as I do myself, I will write my name as the purchaser, and at the end, I will always put and, slash, or assigns. Has anybody ever heard of that? Just say yes or no, and I'll explain if not. Brilliant. You guys are getting to learn a bit more then. And or assigns is allowing me to sell that contract onto somebody else at my when I want to. It's at my behest. So for instance, imagine I got an extremely good deal and I'm buying a property from PJ for $1 million, but the market value is 1.5. By me saying and or assigns, and this is just the contract period of me buying a house from PJ for $1 million, and then Kevin comes along and says, Doug, I'll give you 1.1 million if you let me take over that contract. So that's the and or assigns. I assign it to Kevin and walk away before even closing or recognizing the potential for how much of a profit. So if Kevin takes it $100,000, in the same respect, you can look at options contracts in the same way. You still got 4 months to go, and the terms are very simple. It's a dollar for dollar above 15. So every dollar it goes up, I make $100 over 15 minus my cost. So let me ask you, Owen, if I was holding a contract, so let's say you were aware that I bought this contract from Dave when Apple was at $10 with 4 months available, and I bought it for $250, and then a week later news comes out that they got this great product that's about to hit the market. Everybody's excited. They've all been waiting for it, and it just jumps in open trading to $15. Now you are right at strike with 3 months and 3 weeks to go. But I am going to ask you, Owen, to pay me $5. Would you pay $5 knowing that everything after 20, knowing that this stock not only just jumped from $10 to $15, but it was based upon a new product which could easily allow for momentum? Would you be tempted to buy that knowing you could now take this further and still profit, Owen? Yes, of course you would. And that is how a lot of contracts are actually sold. And do you know what you need to do in order to benefit from potentially and or assigning your contract? What must we make sure we do when we purchase a contract? We need to buy what? What's the most valuable asset there is? Time. The reason you buy time is multifaceted. It's because we give ourselves enough time for the stock to reach the targets that we based it upon or go past our strikes. But that also gives you the ability to sell on the contract before it even gets to strike or overstrike. Now, how do you think we benefit off this more than anybody else, and why we can benefit off this time and time and time and time again? What do we base our trading off? Thank you, Tim. Prince. And why does this become so beneficial with Prince? Because we can actively see the building, we can actively see the volume, we can see the phases of release and go to target or go into the build stage. And even in the build stage, what are we watching closely in the build stage? Aside from the acquiring, and the more acquiring we see, the increase in the potential price target. But what's the most important aspect of of knowing around about a time frame of when it will come out of the build stage and start moving towards its target. What's the most important facet of moving a stock? Volume. Thank you, Millen. Thank you, Tim. Tim, you're doing well today, answering very quickly. Well done, all of you. Excellent stuff. So, are we clear on the basics of options and how to do and what it means? Are we clear? And how we can have a double approach in our method to either wait if we've got everything we need to maximize over strike, or if we've already doubled or tripled well before with lots of time left, even if it's not at strike, we can take so many chips off the table and we can play with house money. But the reality is, let me ask you something. Let's see who's quick here. If I hit 300% return, so let's just say, different situation. Let's just say a different situation is we paid 250 for a contract. Great news came out. And now that contract a week later is worth $7.50. What is my return? 200%. So if I sold 50% of my contracts, how much of my investment do I get back? You get all your money back out. So you're playing with house money. That's why I've always said that if it's 2 to 300, for me particularly, it's more 300%. Why do you think I do 300% when it's available? Because my whole position's in profit no matter what I take off. I could take 50% off, but my entire position would be in 50% profit. It's all about numbers in the end. I want people to be extremely clear on this. Angel, I see still somewhat confused, but I saved questions. Okay, just keep that question and I'll answer it in the next one, in the at the end. Right. So this is the bridge points of the strategy. The first part is the prints. We got formulating the play once we've established prints and their impact being either short term, mid term, or long term. You see, I've condensed it down to ST, MT, and LT, just makes it easier for me in the slides. This is what we will be discussing today. Today's session is going to be simply on prints and psychology. Then the next sessions will be assessing the price target ladder. Number 3 will be a 7-point company analysis. This is where we do a quick breakdown of the company, including its C-suite, which means its corporate employees, CEO, CFO, CMO, COO, etc. Executing the playing options, analyzing the trade, and analyzing the psychology of the trader, which is so important as well. But for today's session, we will be doing number 1 on prints. And here, if you guys remember, I did a session or case study on OKLO. We're going to go past it, go through it one more time so that we can understand, because we're all familiar with OKLO at this point. So short-term prints. How do we know if the build is shorter term? This is a past example, but if you look at the bottom, October, November, December, this was just now. This was last year, and this was also around the same time that we started market making strategy. So this is a really good example. So how do we know if the build is shorter term? When the acquiring or position is small, when they are moving to targets within the day with range still available, relative short-term buying between controlling prints, no intraday consolidations. This is basically mean, as Austin said, the relative size of their buying. The more that they acquire, the more that they build, the more time it will take and the longer it will take for it to hit a price target. That is just basic common sense. The more you want of something means the more you expect it and further to go, correct? Perfect. So now, what are some examples of a short term play? Why would market makers decide on a shorter term play? Give me some ideas. Why do you think, if you see that they're buying, but they're buying enough to get to a target in a short time frame? So, for instance, let's say the print personality. And what is print personality? When we are day trading, as I showed you yesterday, sometimes you will see enough controlled buying to move to a target within the same day or within a day or two. And how do we know that? Because we look at the size of the prints and whether they went to target at the same moment or not. So, for a print personality, for instance, of market makers in a day trade was 3 to 4 prints. It doesn't matter how many shares they bought in each print. So, 3 to 4 prints could mean they bought 5,000 shares, 50,000 shares. We don't look at how many shares within each print, we look at how many prints were executed in the same execution. So, if it was 3 to 4 prints and that was all that's required for it to move a dollar, then if you see that they're acquiring the same day, let's say let's just take OKLO for example, and let's take what we see at mid October over $10. Do you guys see where I am? Who sees that? Now, I'm going to explain to you why this short term, you can see I've got a red around it. Basically, what they're doing in this instance is they would have bought this. I remember between 10 and 15 right here was a lot of acquiring. But was acquiring, but it wasn't a lot of acquiring. And how do we know off the bat it wasn't a lot of acquiring between 5 and 15 around here? How do we know it wasn't a lot of acquiring? Exactly. Low volume. But they did do acquiring, and then this massive volume over 10 comes in. What is that called? So if this stage here, and as I call it in day trading, and we can use the same terminology in longer term or swings, what is this stage called here? This is the build stage, and it was building on lower volume. So if it was building on 5 to 10 million shares daily for 1, 2, 3, 4, 5, let's say 15 days, and that was 5 to 10 million shares a day, then the relative volume to then release this position would have to be far greater. Do we understand that? If you're using 5 to 10 million a day just to build, then the release date would have to be significantly higher, correct? Because now you're moving that entire position towards price targets. In order to move such a large position, the volume required would have to be 3, 4, 5 times that or more. Now, what we do see in the release stage, what do we notice about the volume in the release phase? What do we notice about the volume in the release stage? Consistently higher. So if it's consistently higher, and we know they're meeting targets and they were buying at each level, if you've got enough volume, so the most heightened volume you can have, you can build your position as you're releasing and moving it to the next area. Does that make sense? So if you've got enough volume in the day, you can acquire going up. Can someone tell me what strategy solidifies that understanding that we like to trade? Exceptional build. Thank you, Austin. Correct, Tim. Owen, Millen, spot on. Exceptional build. Make a note. Exceptional build. And Millen, please just type in anything that I speak on just so that everybody can have access to it as well. Exceptional build is when there's more than enough volume for them to build going long. It also implies not only do they have the volume that they require to build their position going long, it also implies that they're seeing a new valuation or stock price for that particular company. So OKLO in October was seen as having a valuation between $10 to $15 a share. With the news, the contracts, the excitement around what it can now provide for the needs of AI and so forth, the market has justified a new valuation of where they believe the valuation of the company is, and if you take it down to share price. Hence, exceptional build is a great tool for understanding if they believe it's got a new valuation. So when we have a new valuation in exceptional build, and then it goes all the way to the top because it went from 10 all the way to 22. What is that calculated move amount? What's the dollar value of that calculated move from 10 to 12 on exceptional build and also releasing from whatever they built from 10 to 15? So if that goes to 12, this is phase one of exceptional build in this particular one, or the release, we can call it. Then it goes into what we now assume is phase two, which we'll be talking about next. But this, let's say now, you guys and we all saw, and we did see this build here. And I actually took my position based off this, a lot of my calls. If you had this, so if you were watching this build, and you're watching on your platform, on your trade station setup, and you see the rooms talking about OKLO, and we're here in October, and it's like, oh, look at this new stock called OKLO. It's building. Oh, wow, lots of buying at 10, lots of buying at 12. It's coming back. And this is going on for about a week. What are you going to be doing after you've learnt my option strategy? What are you going to be doing? You've seen this for days. You're seeing the building. You're seeing all the buying at 8, 9, 10, 11, 12, 13, 14, 15. You're buying contracts. Angel, what's the minimum period or how many months out minimum are you going again? No matter if it's short, mid, or long term? 4 months. Why are we going out 4 months? What are the two reasons we are going out a minimum of 4 months? Derek, we'll get there. Just stay on track, please. Why are we buying minimum of 4 months? Yes, we need time, but it allows us to, one, give us enough time to get past our strike, but it also, because our strategy is based on prints, we have a huge advantage that other options traders don't. Our timing of executing our contract is based on when the smart money is already present. They are already controlling the stock. It's actively moving towards where it needs to go. If you went and had no clue about prints, no clue about how the volume and prints work together, and you went and bought OKLO in February 2024, 4 months out, how good do you think your profits would look? How great would that trade be? It was flatline until October, how good do you think your position would look after 4 months if you went and took OKLO back in February 2024 when it was flatlining, when it was doing nothing? Do you think you guys are going to be have the potential to make 3, 4, 500% return? You're most likely going to lose. Can you do anything if the stock doesn't move, especially in contracts? What's the one thing that we must always be mindful of when we are doing options? It's the most important thing. Time decay. Time decay would not be on your side. The thing that you all need to understand that gives us the biggest advantage as options traders based off prints is our timing. That's why options with prints has such a huge return on investment and success rate, because we are getting in when they are controlling it, when they are actively trading and manipulating the stock, purchasing, acquiring, and moving it towards targets. If everybody on the news, if all your friends started talking about OKLO and every other person in your classroom or where you go to work or in your family, is that going to move the stock? Is that a good reason to get options? Does that give you a high percentage possibility that it's going to move? How about you go on YouTube and look at your favorite YouTube person who talks about stocks? Do you think that's going to help it? Please don't tell me Hello Kitty for a joke or whatever that fella's name is. I'm not talking about that. Or not Hello Kitty, whatever his name, Funny Kitty or Laughing Kitty or something like that. There you go, Roaring Kitty. Yeah, we're not going to talk about that because what do we know? Who moves stocks? Who moves stocks? Who do we see clearly, transparently in prints? Market makers. Who are we following? Market makers. So how can you beat a strategy that starts when they are already building? Because the reality is, if you're watching them build, are you taking it straight away, or are you watching them build, building a case, building the percentages, understanding how big that build is and the magnitude of where that price target could go to? We are technically usually executing on an options contract during or towards the end of when they are building. So while they're over there building a position with millions of shares, we're over here just executing contracts and getting ready for them to do their work. Who likes that as a strategy? Owen, after you see market makers working the way you saw them working in OKLO, did you go validate this trade by going on to Kramer and asking him, or going on to Google and seeing what everybody else thinks about it, or do you trust what you see in prints and market makers? There we are. Okay, so that is short-term prints. Very simple. Short-term prints are typically either they're going to get to the stage of a big build, as we see in OKLO, or a lot of times when you see a short-term build, so basically small enough build to move in a short amount of time, it could also just be on some basic news. Which type of industry or segment do we usually see a lot more short term? Where it goes all the way and then comes crashing back hard, where you know this is a target that I have to be extremely mindful of. And when it gets there, there's a good chance it comes back. Pharma. Thank you, Derek. Thank you, Kevin. Thank you, Austin. Thank you, Shams. Angel with tech. Tech can go either way, but the reality is when something comes in with tech, it's usually more apparent. It will usually stick by nature a lot more for a while. With pharma, what do we know is a typical response system? What is it that comes out and the typical response system is the market goes mental. And the reality is, it's more so the market makers really, really manipulating new volume because it's usually from a cheap stock. The news that typically makes that happen is what? Trial results. Thank you, Tim. Absolutely, it's trials. How many trials are typically in a pharma? 3 to 5 trials. If you fail one, what happens? So if you were good in trial one, trial two, and then you fail trial three, Millen, what happens to that drug? Back to the what? Go back to phase one. But how is that if it was, let's say, for instance, and I'm just going to make this up. Let's just say OKLO, and it's not, but let's just say we're making another name. ABC Pharma Company comes out with clinical trials, and the trial results from the first is really good readings that we have a new cancer drug. Do you think that will excite retail and allow for market makers to get what they need to create a very fun short-term play? Ask yourself a question. And this is talking to you prior to you becoming and coming to market making strategies and having a far better understanding of how things work. But let's say a year ago from now, and you had no clue about market making strategies, and a friend of yours called Millen said, "Guess what, Kevin? ABC stock's only $2, but they just had great results in phase one on their new cancer drug." Kevin, are you going to go and buy something in there if you like the stock market because the potential's that great? Not now. I'm saying just put yourself in a retail mindset, your basic retail mindset of how people typically operate. They would do that. Now imagine not only does that happen, but then Millen told you when it was above 3, Kevin, and then Kevin, it went to 4, 450 in a day or two. And now you start telling everybody else. What do we start creating among retail that really allows these certain short-term prints to really move? FOMO. Perfect. FOMO. Now, how many of you have an issue with FOMO when you trade? FOMO, when your friends or people you know are doing something that you would like to enjoy, and that FOMO takes front and center over the discipline that you should have. Come on, type it in. I didn't ask for an excuse or validation, Millen. I'm asking for yes and no's. We all have it. Millen's correct. FOMO is the easiest way to get participation because FOMO creates this. What word create is create? What is the typical outcome response system for people with FOMO? Greed. Greed. Why else would you throw away all understanding, all discipline, all habits for an instant moment because something is moving? Because you have greed. Do we agree with that? You don't have to agree. See, and I'm going to talk about this in a little bit when we go into the psychology part of this. But one of the biggest problems that we have is that we always work within the constraints of now. When we work in the constraints of now, we are not developing the habit of what the future great trader version of yourself requires. So I will speak on this in a little bit more, but just to add it as we're doing here. Now, next one. Midterm prints. How do we know if the print or build is midterm? Building at levels, acquiring occurs at more than one interval. So basically, it's happening more at, let's say, for instance, is going at for here 30. So it's sitting there on low volume and it is just building at a certain level. They're acquiring and building a larger position than what a short term requires. When they're building a midterm, the position not only shows a near term target, but a secondary opportunity. Why is that? Because we have so much buying that it wouldn't make sense for them just to go towards our calculated price target when we can sell. For instance, let's say we could see that 50 prints hereabouts would be more than enough for it to get from 30 to 35. But then it's acquiring so much that it has 4 times that amount that would be required in order for it to get to 35. What do you think, just looking at that chart on DJT? So again, if during this period here, on low volume, as you can see, let's say that we knew they only needed to buy 3 or 4 times at 30, a maximum total number of, let's say, 50 prints. And that would be more than enough for them to get to 35. Now, let's say they did or purchased 200 prints. So they were buying ridiculously at 30. If you calculated that a fourth of that would get you to 35, but they already have 4 times the amount of that, what is the number that it could potentially get to? 50. Thank you, Tim. That would require, though, that we first have to watch at each level. What information are they releasing? What does it get to 35 and this volume is continually increasing and they're buying more and more and more? As it goes above 35, it's slowly consolidating, but it's continuing with high volume and buying. Does the same at 40, 45. One, this is an extension of buying. And two, it's validating our future targets. Now, what you want to see also is, does it go to 35? So let's say it was only, now let's change this up. It was enough to go to 35. Do we expect 150 million volume to come flying out if the only target was 35? Would we expect this volume to come all the way here if they only needed to get to 35? Because the volume has to be relative, right? The volume is relative to the amount of build. So if they're building massively on low volume, then we would need this type of volume in order to release such a position. But if the price target was only 35, how much volume do you think they'll need to get to a price target of 35 from 30? If you can see it's building here, let's say 15 million shares a day, then to get to 35, you could easily get that in 30, 40 million. So what you got to look at when you're looking at volume is, one, how long they're building for and how much volume they're using on the subsequent day. And obviously within volume, the most important part is the content. Is to know what's going on in that volume. How much acquiring happened at 30? This is how you're building your understanding of what the price target is. We can see on a longer term or midterm, this is increments of $5. So every day that it keeps acquiring here, how many increments now are we going up? Not only how many increments do they need for this type of buying, how much volume is being used. Does that make sense? It's all relativity. If you have a car and you put a quarter tank in it, but it takes a full tank to get to Orlando from Miami, are you getting there? So what can we assume this is? This is them filling the tank. If you don't see them filling the tank, then it will be relative to how far that price target can be extended. Does that clarify it just a bit more? You can only tell if they're filling the tank not simply by looking at the chart and saying that volume must be used to purchase. Is that acceptable in my strategy for you to assume, based off a chart, that this volume is used to acquire here? Is that acceptable in my strategy? You need to see the substance. Thank you, Tim. Need prints. Thank you, Owen. Not only do we need to see the substance, we need to do what? Follow. Write down. Make notations. Understand the magnitude of the buying. How many of you notice how non-stop I will pick up on the stupidest prints and put it in the room? And some of you have no clue. Who pays the most attention to a stock out of everybody in that market making strategies room? Who do you think is paying the most attention? Well, let me say it in a very simple way. By a fucking mile, it's me. Why do you think I'm at the stage I am? Do you think I am working out of my programming of who Doug is today? Or is Doug working out the programming of what the great version of Doug's future version and the great, 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 great trader needs to look like? Which version do you think I'm working out of right now? I'm working out the future version. Because if I was working out my current situation, I would not be moving towards the great trader I need to be. In the same respect, if you want to be a great options trader through this strategy, you must, and write this down. In fact, every single one of you type this in the chat, please. In order for me to be a great options trader based off prints, I need to follow the prints on a daily basis. Now, the beauty about it, you're not day trading. You can have your laptop up with a basic workspace and just watch over your prints. You don't even need to sit there looking at it because we can always do what? Scroll back. You got your filtered over 1,000 prints, and you can even increase or go back and look at different hours, different times. So you have every ability to do that. But if you are not following the prints continually, you are losing the information that you need to understand where the stock is going to go. Let me ask you something. If I see all the build right now, let's just say, just take this DJT for example. We see this and we've been watching this every day for these, let's say, 10 days. And we saw all the acquiring, and the acquiring happened at 27, 28, a lot at 30, and a lot at 31. We saw so much acquiring that among the right release, we know 35, nope, we know it's a minimum of 40 with a secondary target of 50. So we've seen all this occur and we put our positions in play. Do we stop looking at prints at that point and just wait for it to get to 40 and then to 50? You sure? Why not, Austin? So, potential for more room is an excellent answer, but the correct answer is Millen. You are following the market makers. They are feeding you the data. The second you accept your own rules is the second you stop following. And when you stop following, that means you've ended the strategy for yourself, which also leads on to one, there's more potential for more room. But what else could it mean? So let's say right now, DJT, great build. And then we're getting closer and it moves to 35, 36. But let's just say this was prior to him getting the presidency. And you decided not to look at the data. and you decided to base where it should go just off what you saw prior to the elections. And it did move prior to the elections to 35, 36, 37. And you in your head had already banked on 40 with a potential 50, and he doesn't become president. What happens most likely? Are you gonna know there's big selling if you're not following Prince? So does that mean you stopped following, basically? And that's a good point, Millen. They're not waiting for anyone. This is their play. Do you think they know or are happy that we can see them transparently and we are following them? If we had a direct line to the desk that is moving and controlling this stock, and we told them that you are transparent to us, we know what you're doing, do you think they'll be like, okay, I'll call you and let you know? Or do you think they say, I don't give a shit, you're great for knowing, but we don't care. I've got a task here. I've got to make about $100 million in the next 2 months. Do you think I care that you guys are following and that we're transparent to you? In the back of their mind, they say, you lucky, or that's nice. But at the end of the day, they don't care. They don't care at all. When their work is done, either way, they're out. So the risk placed by the MM is too great for small gains. That's why they build such a big position. That all that does is increase their risk. So when they increase their risk, you know they got a higher target. They got technically when you increase your risk as an MM, that also increases their what about the stock. Think about it. When they increase their risk or position, what are they also implying that they're increasing their what about the stock? Not range, not reward. No, this is all outcomes. Sorry, try and type in here. Their confidence in the stock. Thank you, Anthony. Confidence. They're confident about this position. They're confident about this company. Now, going on to the, do we understand midterm? Are we clear? Now, if I say there's a minimum, no matter what, that you should be buying contracts 4 months out, that would apply to minimum short term. So where should you be thinking midterm? Because remember, there's also short term targets. Now, Kevin, 8 months is absolutely correct, 6 to 8 months. But let me ask you, and we're going to go into this next, but I want to put this in your minds. Can you stagger your approach or ladder your approach and do 4 to 8 months out? That we can. We'll talk about that later, but I just want to put that into your minds. So, as we can see, OKLO, here's a short term and the midterm. The short term, that will happen literally, gentlemen and ladies, if you look at it, that happened in no time at all. That happened in a week. 1, 2, 3, 4, 5, 6 days. It went from 10 to 22. If it went from 10 to 22 and your position started here, so let's just say you had 10 contracts, and in the 10 contracts, you're 4 months out. So if you put a position in, let's say, we're going to make life easier here, October 1st, even though we know that this was being built just after October, I'm just trying to make it easier. October 1st, you said, right, I'm starting to see this beautiful build. I'm going to go ahead and buy 4 months out, the 18, and you're probably going to get it a lot cheaper than that, I'm sure, because I remember I did. Okay, let's just say you bought the 15 strike, 4 months out. Its relatively premium is cheap because it's doing what here? It is flying under the radar and they are building. Do you think everybody's watching it here? Or do you think everybody gets exposed to the FOMO here? So when it's here and building, it's flying under the radar. Nobody knows what it's doing. It's not popping up on scanners. They're slowly going about their business. Why do you think they don't want anybody to know what they're doing here? What moves the stock? What moves the stock? Volume. But what moves the stock? Who moves the stock? Retail. And what did I tell you? Retail loves more than anything else and will always stand by it. FOMO. So once they've built their position here, massive volume comes in, all of their indicators go off, their rapidly rising goes off, it gets on the news, you see OKLOs moving, the highest percentage, blah, 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 blah. This is where they built, this is where they needed FOMO and retail. Once FOMO and retail came in and pushed the position up, now they've got excitement, interest, and exposure. They've got continued participation. Now they really build the position. Does that make sense? Fly under the radar, build your initial position. Now, all your retail and all the TA and technical analysis and indicators and everything else they use starts flying off. They all join the fun. They all like the exposure. They all do their weak research and follow what they're told. Then it gets here. They got massive levels of interest. Now they're compiling the big position because they got the big volume and they've got consistency in those who are participating. But we took our position October 1st. So if I took a position 4 months out on October 1st, what is my time decay? What day does my contracts expire? February 1st. So, Millen, if my contract or strike price is $15 February 1st, but by mid October, I'm already $7 over the strike price. What can I do to my position? Do I sell everything? Am I able to sell 5 of those, Millen? Now, if I pay $2 a contract, it's $7 over the strike. We could potentially be up $8, $9 in premium. So if we pay $2, let's just say to make it easier, it wasn't 8, 9, it was $10. So now the value of your contract on the open market, because it's now at 22, 2 weeks after you executed the contract, it has a far higher premium at $10, well over your strike. What would, if you sold it all right then and there, what would be your return, Millen, in 2 weeks? You paid $2, you sold it for 10. Come on, give me some quick math. 5x. So 500% return. If you sold 50% of that and let the other 50% run, because now you're going to be managing your midterm position, how much did we get back if we sold 50% of it? Two and a half X. Does 2.5x, PJ, give you back your investment and a huge profit on the entire position? So can you manage within the same strategy short term and midterm then? Now, if it goes into this next stage and there's nothing but buying, can we go and buy contracts 4 months out or 6 months out again? So what determines that? What determines whether we can extend our contracts in place? What determines new prints? Hence, the strategy is and only is based off prints. Are we clear on this? Perfect. Okay, now this is how, and you guys will be given a very simple tool that we've created so that you can place all your prints, have a way to understand it. Everything else, you'll see that we're going to have that later on. We'll give it to you after the course. But this is a basic look. So prints. Understand the print strategy is vital so you're able to plan how to strategize your options play. Options require you to be resourceful with limited time and diligent with management at price targets. Below, we will see a case study of a planned trade we took in DJT. So this is just showing how you can, and this is what we will be giving it to you all, so you can use this, or you can create your own, whatever's easier for you. This is just one that I did. So you got your date, the prints 15 to 20 multiple buy, the volume increasing daily. So now we're seeing we've got short-term and mid-term possibilities. Bit of comments. The build console between 15 and 20 was huge. Volume consistent, increasing daily. Vote month. Why do you think I put vote month into the comments of this? Well, not Trump's ticker million. Why would I put vote month in the comments of this particular stock? Why is vote month important? Come on, I just told you. That's right. It's the catalyst for the trade, or the other way. Think about it. Why do you think DJT was moving? Bit of common sense, guys. I can't teach you common sense. Common sense tells you if the man's going for presidency and his name's Donald J. Trump and he has a stock and it's a media company and all fingers are pointing towards him winning, what do you think is going to happen to a stock that he owns? Come on. Write that down. Put it in the group thing. I can't teach you common sense. Use common sense. Use common sense. You know how much we don't use common sense? I'll explain this to you on the side. How many times are you susceptible to accept an invitation to do something that you don't want to do? Or that you should not be doing? Many times. And you know why? Because we forgot to use our common sense that we shouldn't be doing it. So use the common sense. It's such a valuable tool. So being a vote month, I need to pay attention because this is in October. We're only weeks away from being announced. So the closer I get to the announcement, or the closer we're getting to understanding who's winning, what should we be most likely looking to do with our position? Manage. We're going to be looking to manage. Do you not think overall in this DJT, I was looking at this as a long-term, mid-term, or short-term? Absolutely short term. Now, does that mean in any way, if everything was going well and it moved far beyond my targets, that I wouldn't keep a portion of my position until a bit longer, depending on on how much time I had? Of course not. But the reality is, this was definitely a short term. Now, for those of you who were watching the prints in DJT during that period, did you notice how the buying at each level was consistent with short term and the volume was extremely high, consistent with short term? Who noticed that? If you were watching. If you weren't, go back and you'll see the chart. And I'm just going to let you know that it was high volume consistently, as short term does, but it was also short term type prints. Those were moving and acquiring quickly. So, and then the MM strategy, short term, mid term, buy and volume. First price target was $30. And this is exactly what it was. Time frame for options was 4 months. Continuation of prints. This is if you're starting seeing it gets to 30. Now there's more buying. Write it down. Strategy first, price target. You can continue the play. Management side. And the second, 12 separate times I was buying at 30. This was what this was exactly how it was, by the way. This is not me making it up. They bought at 30 12 times. I watched it all execute. The volume was in a holding pattern. Why is a volume holding pattern buying at 12 mean? That means they're building a monstrous position. When you're building a monstrous position, although my first price target was 40 based on the amount of buying, based on the increments, but with that much buying, there was no way that it couldn't get to 50. Hence, that's my second price target. For me to have far more faith in my second price target, for me to manage a lot less of my position, what do I need to see at 40? And what do I not need to see at 40? More buying? Absolutely. It's a continuation of the same prints. So I want to see a continuation. I don't necessarily want to see it as large. And why would it not be surprising that the buying and building around the 40 would not be as large? Why is that? They've done their work. And where did they do most of their work, Austin? Perfect. Thank you. Are we clear on how you can write this down? And you, as I said, we will be providing these tools to you, but is this clear of how you can lay it all out and you can follow your work on the actual positions? Perfect. Long-term prints, as you can assume, acquiring occurs for days. Prints at controlling levels are too big for short or midterm. Millions of shares purchased at specific levels. A huge position taken one time. Sometimes you're going to see a stock is doing absolutely nothing and somebody bought 2 million shares and then nothing ever happens again. Can we create a trade, a short-term or mid-term trade off that? If it was just one time somebody bought a bunch of shares and nothing else we ever seen. We didn't see continuation of volume or acquiring. No. That's somebody who has hope for that stock for the future. But let me ask you another thing. What is ACHR starting to look like or is looking like? What, PLTR? 100% Palantir Austin. That acquired under 10 for many, 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 many months. What are we seeing with ACHR on a daily basis between the 859 and 10 level? Is it small build, Millen? I love that. So much build. Exceptional build. No, it's heavy. So are you going to go 4 months out in that particular position, Austin? Where would you be thinking? Minimum 12 months. Because it's showing you they're building a position for the future, not a position for next month or 4 months or 6 months. So pay attention to that. And that is it for that class. Now, raise your hands if you have any questions. But while you're thinking of questions and raising your hands, I'm going to do a quick 5 minutes again. Could we see the last slide again? Yep, absolutely. There we are. I'll keep that on there. So when you look at short term, mid term, and long term, again, it's all a bit relative, and it has to be relative to the size of the buying, the amount of volume used, and how do you make that relative to what? Who here, again, is asking themselves, Doug, what am I making the volume and buying relative to? Who's still answering or thinking about that? This is what relative means. When the stock was doing nothing, do you see that? So let's say when OKLO averages 3 million shares a day, its average range is 30 cents. I'm making this up, obviously. When OKLO was averaging 6 million shares a day, its average range was $1. When OKLO was averaging 50 million shares a day, its range was $4. Are we understanding how we make it relative now? That's the only way to do it. The relative range is the relative volume increase. It can move more when it has more. So when you see it has a lot more volume and within that a lot more buying, there's two things that are going to happen. One, you can calculate your calculated move. So if you see, for instance, this was building all the way from 15 to 28, which is what it was. To make life, 17 to 28 or 29. It was a 12. What was this 10 to 22? How much was that calculated move? What is 17 to 29? Because that's what the top was. I'm sorry, I didn't put it in here correctly. So then we can see it's building here, and now it's tightening up into a flag, and it's starting to come over this 22, 23. So if we added 22, 23 and put 12 on there, and we looked at the implied psychological level it should get to, what's that number? 22 to $23, around about that, plus the $12 calculated move off this build will take us to what psychological number? 35. Thank you very much. Spot on. Now, let's go a bit more in detail. We can see the massive volume that it took here, but when it goes to 35, the volume is still remaining about this high, not money time high. What, if you remember from yesterday, what does that start to imply? Why can it go the same distance on less volume now? Hey, well done. You're all paying attention. It can do that because the institutions are holding on. Do you like that? Do you like to see the same money flow on a lot less volume, knowing that that could indicate that institutions are holding massive amounts of shares? Are you a fan of that? Oh, yeah. Why is that? Oh, yeah, villain. Great case. What can that do to your ROI if it can move a lot more and a lot less? Oh, yeah. Are we seeing that currently in OKLO? So my April strike is 30 and 37. So if we looked at the April 30 strike, how is that looking right now? Not bad, is it? Do you think I'm holding my entire position I took back then? I'm going to give you guys a shot and I'll tell you the truth. How much do you think I'm still holding? Now, remember, I can read this a lot better than everyone, obviously. So I can see things that you guys are still learning and you will definitely get to. Hmm, not bad, Derek. Higher, 75%. Why do you think I'm able to hold 75 or 80%? I didn't buy back, Kevin. My position was already massive. One is trusting the prince. But if it goes to 59 from 30, did it take much selling for me to not only get all my money back out, but make a really nice return on my full position? Would it take as much? One of the things you got to do in options, and be quick to do it, as quick as you can, unless it's just flying, you got to have a number that you're going to take off in order to take your risk off the table. So when it got all the way up in the 50s, I'm up now 20x on my position or 15x on my position. I could take 25% off, bring all my money back, and make a massive profit. And I left 75% because of what? Why did I leave 75% of my calls? Who tells me to sell? Who tells me to sell? I'm only following, gentlemen and ladies. I don't have any opinion in the market. I don't make any assumptions in the market. I simply do what? Whether it's day trading or options. What am I doing? And here's the reality. The fact that we can transparently see them and we've got the eagle eye, do you really want to do what they're doing, or is it better just to follow anyway? Do you want to be responsible for what they're responsible for? Do you want their stress? I don't. Do as you're told because it proves to be extremely fruitful, profitable. So you just follow. Okay, we've got 10 minutes left here. Questions? Any questions? Angel. Melon, let Angel speak, please.
Hey there, can you hear me?
No, I can hear you.
So this is more of a clarification, and I think Anthony kind of answered me in the chat, but I got a little confused earlier when you were talking about and oring with the options contracts. So
Okay, I'll make it
my
real clear.
question,
Go for it.
yeah, I was just wanting to understand because I think I got confused when you were talking about the premium going up. So if I've already paid my premium at 250, for example, and an Apple jumps to 15 and the premium is now $5 or 750,
Yep.
my cost doesn't go up. That just means I can sell the contract that I've bought for that $5 or 750 and just make a quick profit before I even reach the end of my contract. Is that understanding correct?
You are spot on.
Okay. Okay. Thank
Absolutely
you.
spot on. And you only, Angel, you're going to know. And what I was saying on this is that possibility is so high and happens most of the time because we trade off prints. That means our timing is usually around about the time it's about to go into money time and move past that build period. If you didn't have any understanding of prints and you simply wanted to buy options in
Hmm.
OKLO, you have no idea what's going on in that volume. You have no idea what they're doing every day. You're simply guessing and hoping it will stick.
Okay.
Our options are executed based upon prints. So right now, if you told me, Angel, Doug, let's all take options in stock BBAI, do you think I'm going to do it?
Not without looking at the prints.
There you go. You got the answer too. That's the exact
Got it.
answer I need. Got it?
Got it. Thank you, Doug.
Perfect. Yeah, no problem, Angel. Anyone else? Anybody else got questions? So has that been clear enough for everyone about how the prints work and how to understand short term, mid term, long term? Are we clear?
We have one more question, Doug. We have Kevin.
Oh,
Hey, Doug,
okay.
I just had a quick question on stocks with low float, like Oklo here. It's about figuring the price target based off of how do you figure that price target? I hear you say this has got enough for 75. What determines that? Is that the prints telling you that? Is that just screen time, or is there something
So,
within the volume ratio that you're seeing that makes you determine
well,
how
that's
far
what I
to push
told
the
you.
price?
Look, on your platforms, the one tool that you guys all will have access to if you get TradeStation is the tools that we had built specifically for us. So what it tells you is how much volume and how much range that stock typically moves within the volume that it has. So if
Yes.
you looked on your platform on a daily basis around this area, so this early part of September in OKLO, for instance, maybe it said the average volume per day is 1 million shares or 3 million shares, and the range is 50 cents. Then as you were watching it now get new levels of interest and volume here at mid-September through to mid-October, in this section, you're going to notice the volume is now somewhere in the range of 5 to 10 million. And because there's a lot more volume, they can move the stock a lot more on a daily basis. So now the range might be $1. So when we're looking at the buying in this period in September, we're saying, okay, if there's 3 to 4 prints at a level, we can assume it can move about 50 cents or towards around about that range. When we get double the volume, we can see the range is now moving $1. So if you've got one set of prints on a daily basis, you know that, let's say it had buying at 10, it can go to 11. But now if for a whole week or two, it buys at 10, maybe 8 times or 9 times, now we're going to start adding increments. So let's say that the increment was 50 cents. So increments are never $1, by the way. They're always 50 cents. We don't do increments of $1. So we can say, well, there's enough buying here at 10 now because it printed there 10 times that this has got a minimum of $5. So from 10, that would be 15. But if they were buying from 8 to 12 or 8 to 15 or 10 to 15, that means that they're buying in a $5 range. That's completely different. Now you start doing your calculated move. So you can see that if they're buying in a $5 range and the volume comes in, you got to know that if it's buying up from 8 to 15, there's a minimum what in this? What's the minimum target?
I would have said 20.
20. But is that the reality, knowing that we saw them buy between a massive range of 8 and 15?
No.
Because why would you buy up and down $5 just for it to go $5? Does that make any sense?
Yes, it does.
It doesn't make sense, right? So if you were acquiring shares between a range of $5, you wouldn't buy all the shares between $10 and $15 simply for it to go to 20, would it?
No, you're looking for more like 50 or so.
So potentially, we don't want to take our targets and throw them in the stars, right?
Yes. Well, based off what we saw after that, I guess is why I said that. I know.
Yeah, no.
25 and 30.
Exactly, but that would be, you'd always also would have to have your first target, second target, third target, and know what you need to see to keep that percentage high at each of those targets. Okay?
Got it.
Perfect. Anyone else? Sid, are you serious? What did I just do? So at the end, on next Thursday, I'm actually going to go through a full case study with Prince. It's the same one I've done before, and I'll be outlining all the tools that we used. Not only outlining the tools that we use, but the 7-point company analysis will be filled out. I'll show you actual prints and so forth. But it's basically what I just did here, but it's going to be with prints. But this is pretty much how it goes. Okay, any other questions? If not, time is up. Okay. Thank you all for joining for Options Class 2. I will speak to you all tomorrow at 11. Have a lovely day. Thank you so much.